Hello everybody, this is Dr. Gary Zinn with AvoidWeakMarkets.com. In this video I want to introduce you to our risk-adjusted asset allocation model, which can help you make money by not losing money. Our risk-adjusted asset allocation model is a quantitative computer model that objectively identifies different market conditions. Its signals are presented graphically in two panels, an upper panel and a lower panel. In the upper panel, the data stream is for the NASDAQ 100 index, which is representative of large cap growth stocks. The data stream in the lower panel is for the S&P 500 index, which is representative of the broad market. The signals are shown graphically as a buy signal represented by an up arrow, and the down arrows represent sell signals. The data elements and calculations in each of these upper and lower panels are different, and therefore the timing of the buy and sell signals in each of these panels is different. This is how we interpret the model signals. When the funds in each panel are on a sell, our research shows that these are weak market conditions, and it is very difficult to make money in the stock markets. While some funds do advance during these weak market periods, the majority of equity funds tend to decline. So again, weak market conditions are identified when we have a sell signal in the upper panel and a sell signal in the lower panel. So we need two sell signals. Any other combination of buy or sell signals in these two different panels does not indicate weak market conditions. And this is how we use the risk-adjusted asset allocation model. When the model signals weak market conditions, move to the safety of a 100% cash or money market position. Then when the model signals a change to some other condition than a weak market, re-enter the market with a portfolio that is suitable for your individual investor profile. This model does not require active or very frequent trading, but it does require you to be alert for the signals identifying weak markets. The model identified only 8 weak market periods in the 20-year period from 1990 through 2010. And this is a list of those 8 weak market periods that it has identified from 1990 through 2010. Let's look at the signals and see how well they identified the weak market periods. The significant weak market period occurred in 2000 to 2001. In this upper panel, we see a sell signal developing here, followed by a sell signal in the lower panel here, identifying the beginning of a weak market on October 13th of 2000. And you can see that subsequent to this beginning, the signals identifying the beginning of this weak market period, the market did drop substantially and violently. Our weak market signal continued in effect until we got this buy signal in this upper panel, indicating the end of this weak market period on November 14th of 2001. The next signal we got identifying a weak market period developed on June 4th of 2002, and here's how it developed. In the upper panel, we had the sell signal develop here, followed by another sell signal in the lower panel on June 4th, 2002, identifying again the beginning of another weak market period. The market did drop and continued in its downdraft until we got a buy signal in this upper panel on November 4th, 2002, ending this weak market period. Subsequent to that, we had another weak market signal, and here's how it developed. We had this sell signal in effect in this lower panel, followed by another sell signal in the upper panel, indicating the beginning of another weak market on January 30th of 2003, which this weak market period stayed in effect until we got this buy signal on March 24th, 2003, ending this weak market period. Subsequent to this buy signal, the market rallied substantially. And note that the signals from this model correctly identified the beginning of these weak market periods, and equally importantly, correctly identified the time at the end of the weak market period when it is appropriate for investors to re-enter the market and benefit from the rally that follows substantial market declines. The next serious market decline in this 20-year period occurred in 2008. Let's see how our model identified that weak market period. You can see in this upper panel a sell signal here, followed by another sell signal in the lower panel, identifying the beginning of a weak market period on January 9th, 2008. This weak market period stayed in effect until we got a buy signal in this upper panel, ending the weak market signal on May 2nd, 2008. So the market started to drop substantially, but held and rallied, and our model ended the weak market signal here on May 2nd. Another weak market developed, and here's how the signals developed. We see a sell signal in this lower panel, followed by another sell signal in the upper panel, indicating the beginning of another weak market period on September 10th of 2008. And you can see, subsequent to this identification of this weak market period, the market dropped substantially and violently over the next few months. Our weak market signal stayed in effect until we got this buy signal, canceling the weak market signal on March 24th of 2009. And note again that the model correctly identified the time to re-enter the market and to benefit from the rally that occurred subsequent to the weak market period. In this chart, we also see that the model identified another weak market period beginning on May 21st of 2010 with sell signals in both panels. It indicated a weak market period here, ending with this buy signal in the lower panel on August 3rd, 2010. And again, you can see that although the market did not drop substantially, the model correctly identified the end of this weak market period and in time for the investors to enjoy the rally that subsequently developed. There are several other similar type of weak market conditions that have developed in the 20-year period, similar to this, where the market did not drop substantially, but the model correctly identified time to re-enter, so no investors were left behind as the market continued to rally. You never know when you get these sell signals whether or not the market is going to drop violently and substantially like it has done here, or whether you're going to have just a little sideways movement. So you have to follow each one of the signals as they develop. Now, by simply looking at the previous charts, you can see our completely objective computer model has correctly identified the significant weak market periods in the 20-year period from 1990 through 2010. These included all the weak market periods during which most investors lost substantial portions of their assets. And equally important, our completely objective computer model correctly signaled times to re-enter the market after the corrections. If you were invested in the stock market during these time periods, think about how much better your portfolio would be if you had moved to the safety of cash or a money market during these weak market periods. You can see a complete history of this computer model signals for the 20-year period from 1990 through 2010, as well as examples and demonstrations of the benefits of applying these weak market signals to different portfolios at avoidweakmarkets.com. You can use the avoid weak market signals to help you make money by not losing money. We interpret the signals for you and tell you whether or not it's identifying a weak market or some other market condition. For more information, go to avoidweakmarkets.com. Here's disclaimers. These analyses have been developed by testing historical data with completely objective computer models. There's no subjectivity by humans inputted into these individual signals as they develop. All data have been acquired from reliable sources, but complete accuracy cannot be guaranteed, and these data are provided for information and education, and no specific investment recommendation is made for any individual investor. Investors should always seek the advice of a qualified investment professional. And of course, past performance does not guarantee future results. You can make money by not losing money. For more information, go to avoidweakmarkets.com. Thank you for watching.